The commodities world is not just moving, it is erupting. Gold is flirting with $5,000 an ounce. Silver just came off an all-time high of $121.64. Bitcoin is sitting confused in the corner at 66,000 while gold quietly outperformed it by 70% last year. And the forces behind all of this? They are so deep, so structural, and so alarming that if you are not paying attention right now, you could be watching the biggest wealth transfer since the 1970s happen right in front of your eyes and miss every single dollar of it. So buckle up, we are going all the way in today. OG John AG here. I'm about to break down could be the most important financial conversation you hear all year. Today is February 19th, 2026. A quick silver update. Silver XAGUSD is showing mixed but predominantly cautious technical signals as of February 19th, 2026, with the spot price hovering around $77.60, $78 up roughly 0.71% intraday from recent lows near $76.77. Futures are trading similarly around $78, $78.10, reflecting a modest rebound amid ongoing consolidation after recent volatility. Current price snapshot, spot silver, approximately $77.63, $78.02, bid-ask range, with gains of plus 0.55 to plus 1.09% today. Key intraday range, low tilde $1.76.35, high tilde $1.79.37. Broader context, silver remains in a corrective phase after earlier 2026 rallies, down from peaks near $100 plus, but holding well above major yearly lows. Support, immediate, $76.40, near daily mean and recent bounce zone. Stronger, $75, then $73, $72.60. Demand zone tested recently. Break below could target $70.89 or lower. February lows around $63.90. Major floor, mid-$70s to $70. Seen as a potential institutional accumulation area. Resistance, immediate, $79, $79.10, $80. Mid-supply zone, psychological barrier, and frequent rejection point. Noisy trading here. Next, $82.40, $82.50, then $86, $90. Bullish targets if breakout occurs, some patterns $92 plus longer term. Now, let me start by painting you the picture of 2025, because if you missed it, you need to understand just how historic what happened really was. Gold rocketed 55% last year. 55%. It hit 53 all-time highs in a single calendar year, the strongest performance since 1979 when inflation was literally eating people alive. The average price across 2025 was $3,400 per ounce, but by Q4 alone it had surged to $4,100. And right now, as I'm talking to you, spot prices are hovering between $4,956 and $5,015 per ounce, up over 1% just today as U.S.-Iran tensions simmer. That is a 2.5 times gain since October 2022. Outperforming stocks, outperforming bonds, outperforming crypto in most stretches. And here is what's wild. Gold did this while the S&P 500 was also roaring. That defies everything the old textbooks told us. Gold is supposed to shine when everything crashes. But it didn't need a crash, it just went up anyway. Why? Because this is not your grandfather's fear trade. This is a fundamental restructuring of how money itself functions on this planet, and I'm going to prove it to you with 3 unstoppable forces that are not slowing down, they are accelerating. Force 1, currency debasement. And this one should genuinely concern you. Since COVID, the US M2 money supply exploded from $15 trillion to $22 trillion. That is a 40% jump in just a few years. US national debt, sitting at $35 trillion and climbing. Interest payments on that debt have tripled to $1 trillion a year, more than the entire defense budget. Let that sink in. The United States is now spending more on interest payments than on its military, and the only real way out, historically, is to inflate the debt away, not cut spending, not grow fast enough. Print. And when you print, you are essentially cutting a pizza into more slices without adding any pizza. Your slice, your savings, your purchasing power gets smaller every single day, whether you feel it or not. That 20% stock market gain last year, for anyone who was not invested, that was not prosperity, that was 20% inflation hitting them in the face. Wisdom Tree's models project gold at $5,500 to $7,000 by 2030 on just modest money growth. Crank inflation to 7% annually, and those same models scream $7,000 near term and $25,000 by 2050. And critically, even in a deflationary scenario, gold still climbs because it remains the only asset no government can manufacture. Track the M2 to gold chart weekly. That chart is your crystal ball. When M2 surges unchecked, gold outperforms by design every single time in modern financial history. The 1970s saw gold surge 2,300% during the last great debasement cycle. Today we have the same pressures with a $35 trillion anchor pulling the dollar toward the ocean floor. Before I get to Force 2, if this kind of raw, unfiltered market analysis is what you're here for, smash that subscribe button right now and hit the bell, because OG John AG does not sugarcoat, does not hype without data, and does not leave you guessing. Let's keep going. Force 2 is the one that Wall Street did not see coming and still does not fully appreciate: central bank buying, and the numbers here are genuinely shocking. In 2022, when the United States froze Russia's $300 billion in foreign reserves, something cracked in the foundation of global finance. Every nation watching that, China, India, Turkey, Poland, Saudi Arabia, Brazil, they all quietly asked themselves the same question: if America can freeze our reserves, why are we holding dollars? And the answer they landed on was gold. Central bank gold purchases quintupled after 2022, over 1,000 tons per year for 4 consecutive years. Goldman Sachs says every 100 tons of central bank buying lifts the gold price by 2%. At 750 tons annually as a baseline, that alone is structural rocket fuel. 95% of central banks surveyed plan to increase holdings further. China currently holds only 8% of its reserves in gold, compared to the United States at 70%, meaning China has enormous room and obvious motivation to keep buying. If geopolitical tensions like US-Iran escalate further, some analysts think annual buying could spike to 1,500 tons, potentially moving prices 30% in a single surge. This is de-dollarization in real time, and it is not a trend, it is a tectonic shift. If China begins aggressively dumping US treasuries in exchange for gold, and early signals suggest this is already happening, the bond market could face convulsions that would make 2022 look like a warm-up. Goldman Sachs currently targets $5,400 for gold by end of 2026, revised up from $4,900 just in January. JP Morgan's base case is $6,300, with upside scenarios pointing to $8,000 to $8,500 if households shift even 0.5% of their portfolios. These are not fringe forecasts. These are the biggest banks on the planet putting their names on these numbers. Force 3 is where the real explosion is hiding, and most retail investors are completely unaware of it. Despite gold being in the middle of one of its greatest bull runs in history, global retail allocations to precious metals are still under 1%. Under 1%. Morgan Stanley recommends 15 to 20%. JP Morgan models show that a mere 0.5% shift in household allocations globally equals $6,000 gold on its own. We are in the earliest innings of a retail awakening that, when it fully ignites, and it will, could amplify this rally in ways that will shock even the most bullish forecasters. Picture the shift from traditional 60-40 stock-bond portfolios to a 60-20-20 structure with gold included. The flood of capital that represents is not billions, it is trillions, and it has barely started. Now let's talk silver, because silver is where things get truly unhinged in the best possible way and the worst possible way depending on your timing. As of right now, silver is trading between $78 and $79 per ounce, up roughly 1 to 2% today. But here's the context that matters. On January 29th, silver hit an all-time high of $121.64. Since then, it has pulled back about 17%. Year over year, though, silver is up 139%. 139. That outpaces gold's 55% by a mile. And the structural reason silver does this, explodes harder and faster than gold in bull markets, is because silver is not just a monetary metal. It is an industrial metal. 60% of global silver demand comes from solar panels, electric vehicles, AI semiconductors, medical equipment, and advanced electronics. And that industrial demand is not slowing down. It is accelerating. Here is the part that should shock you. The silver market is now staring down its 6th consecutive annual deficit in 2026. 6 years in a row where the world has consumed more silver than it has produced. The cumulative shortfall since 2021 has hit over 800 million ounces, equivalent to an entire year of global mine output, gone from inventories. The Silver Institute projects another 67 million ounce deficit this year alone. COMEX registered inventories have cratered down 75% at certain points, sitting at 82 to 98 million ounces, with massive weekly withdrawals hitting as hard as 33 million ounces in a single week in January. Physical demand is overwhelming the paper market. Institutions and central banks want real bars, not futures contracts, not promises, and premiums in Asia are elevated, signaling a supply squeeze that is tightening its grip. Concern alert: at current drain rates of 20 million ounces per month, we could be looking at hard resets, forced price discovery upward, or outright delivery failures on paper contracts. This is not hypothetical. The conditions for a silver short squeeze are more mature right now than at any point in modern market history. Where does silver go from here? JP Morgan sees an $81 average for 2026, with Q4 hitting $85, though they openly acknowledge bubble risks, given last year's 130% surge. Goldman Sachs is calling $85 to $100, naming silver the primary strategic metal of the green transition. Bank of America has an outlier upside case of $135 to $309 if the gold-silver ratio compresses to historical norms. Right now, that ratio sits at roughly 64 to 1, meaning it takes 64 ounces of silver to buy 1 ounce of gold. In 1980, at the last great precious metals peak, that ratio hit 15 to 1. If gold reaches $6,000, which JP Morgan has modeled, and the ratio compresses even to 30 to 1, silver would be at $200. That is not a dream number. That is basic historical math. Trading economics models, silver at $79 end of Q1 and $92 in 12 months. Consensus sits at 80 to 90 average with significant upside if the physical squeeze intensifies. But I have to give you the real talk here because I am not going to let you walk into this without understanding the risk. Silver is violent. The January 30% drop from 121 to where we are now happened in less than 3 weeks. Institutions can and do use retail FOMO as exit liquidity, meaning they let you get excited at the top and sell into your enthusiasm. Miners are even more extreme, 2 to 5 times more volatile than the metal itself. Labor strikes in Peru and Mexico, which account for 50% of global silver supply, environmental regulations and hedging programs can destroy miner gains even when silver itself is rising. And silver's industrial sensitivity means a global recession could tank it regardless of monetary tailwinds. Now, let's bring in the one comparison everyone always asks about, and that is gold versus Bitcoin, because as of today, Bitcoin is sitting around $66,000 to $67,000, down about 1.25% on the day after swinging between $65,722 and $67,195. Year to date in 2026, Bitcoin is consolidating hard after a volatile 2025 where it peaked near $98,000. Meanwhile, gold is up over 15% year to date and compounding. In 2025, gold beat Bitcoin outright, up 64 to 65% versus Bitcoin down 5%. That is not a footnote. That is a complete dismantling of the digital gold narrative, at least in the short term. Here is how they compare where it actually matters for you. Bitcoin offers asymmetric upside, potential 10x moves in favorable cycles, and it is portable, borderless, and increasingly institutionally adopted via ETFs holding billions. But its volatility is extreme, its correlation to tech stocks is high, and regulatory risk remains real. Gold offers centuries of proof, central bank endorsement, negative correlation to the US, dollar, and steady accumulation without the emotional roller coaster. The Bitcoin to gold ratio right now sits at roughly 13 to 1. The directional call you make there depends entirely on whether you believe we are in a risk-on recovery or a continued flight to safety cycle. Most institutional models in 2026 are still favoring the latter. So, what does OG John AG actually think you should do? Here is the framework, and this is not financial advice. Do your own research, consult a professional. 5 to 10% allocation in precious metals as a base, with physical holdings as the foundation, because physical cannot be printed, seized digitally, or counterparty failed. Silver for amplified upside, given the deficit dynamics and ratio compression potential. Gold for the long-term monetary anchor. Mining stocks as a calculated risk. If you understand the volatility in the 1970s, miners outperformed gold 5 to 1 during the bull run. For traders, watch gold resistance at $5,100 to $5,200 and silver support at $63.90, with bulls eyeing $90 as the next major target. Monitor CPI prints. Hot inflation readings paradoxically can tank metals short-term as rate hike fears dominate. Monitor COMEX weekly open interest spikes and open interest combined with inventory drawdowns are your squeeze signal. The broader picture is this. Currency debasement, central bank de-dollarization, and awakening retail demand are not 3 separate stories. They are one story feeding itself in a loop that has no obvious off switch. Governments cannot afford austerity. Growth alone cannot service $35 trillion in debt. Printing is the path of least political resistance, and gold and silver are the oldest known answers to that problem humanity has ever found. If you think in historical cycles rather than quarterly returns, the setup in front of us right now is the most compelling precious metals environment since the 1970s, and that cycle produced a 2,300% move in gold. That is your deep dive for today, February 19th, 2026, from the numbers Wall Street buries in footnotes to the structural forces reshaping global finance in real time. If OG John AG gave you something to think about today, do me a favor and subscribe right now. It genuinely helps me keep bringing this level of analysis to you every single week, and I see every single one of you joining this community. Hit the bell so you never miss a breakdown. Drop your take in the comments. Are you stacking physical, trading futures, holding miners, writing Bitcoin, or sitting in cash watching? I want to know where you stand. This is OG John AG. Own what they can't print. Peace out. Stay stacked.